are you?
Good. Do you feel uneasy with the way the real estate market is and interest rates are right now? Interest rates are going up. There's limited supply. There's multiple offers. Hi, I'm Sherri Anderson with RE/MAX First Advantage, and I thought it'd be a great idea to talk with a local trusted mortgage loan originator in our area to pick her brain and ask her a few things, why we should maybe buy now, wait, how much money do we need, how can she help sellers buy without selling their current home. So today I'm meeting with Ellen Puchalsky with Northpointe Bank. I love working with Ellen. She's helped many of our clients. She's local, so she can actually sit down and meet with them face to face. And she has a lot of creative ideas to help you, the buyer, get the house that you want.
So my name is Ellen Puchalsky. I work for Northpointe Bank. I've been in the mortgage business for 19 years. So a little bit about the bank and ourselves and what we do is we are local to the Campbell area, but we also do service all 50 states. So most of our mortgages, we can help anybody that's moving from Central PA to a different state, to a different location, buying an investment property or buying a second or vacation home in another area. So that makes us very unique. We do offer a lot of different loan options to try and fit the needs of all of our borrowers, whether they're buying their first house and being a first-time home buyer and looking into local grant or state programs to maybe help them out. We also offer loans for veterans. We do new construction financing, so we really do have a loan for everyone to meet their individual needs. Over the last several months, interest rates have been on the rise, and as most of you know, the Feds plan on adjusting the interest rates several more times throughout this year and into 2023. So one of the things that we look at, a lot of people are comfortable or have heard multiple things about fixed rate mortgages and they assume that that's the best option for them, but there's also different options out there. So depending on what type of mortgage you're looking to do, fixed rate might be the best option for you. But have you looked into buying points where you pay a certain portion of your loan amount to basically buy down your interest rate? So that could be a good option for you as well. There's certain types of mortgages that have mortgage insurance because you're putting less than 20% down. Conventional loans also give you the option to do what they call a mortgage insurance buyout, which might be a good option for you. So instead of paying an extra $60, $80, $100 a month in mortgage insurance, you could potentially pay a smaller fee up front as a one-time fee so you don't have to pay mortgage insurance anymore. Adjustable rate mortgages are very popular these days just because interest rates are rising and people do want the lower monthly payments, and adjustable rate mortgages do offer lower monthly payments, which is nice. So if you're buying a house and you think it might be your next 3 to 5 year home, and then at that point you plan on, maybe you just got married, you plan on having children, you might need a bigger home at that time, you can take an adjustable rate mortgage that is fixed for, generally there's certain periods of times, 3 years, 5 years, 7 years, 10 years, but the payments are amortized over a 30-year period, so your payments stay nice and low for that initial 3, 5, 7 years. So it just benefits with having a lower monthly payment. So if you would even take an adjustable rate mortgage with less than 20% down and pair it with paying points to buy down your interest rate and possibly even doing a mortgage insurance buyout, you're doing all those things to help you save money and lower your interest rate and your payment.
So right now today, I believe interest rates are right around 6%, 6.25% for a conventional 30-year fixed rate. I know when my husband and I bought our house many, many years ago, it was 11%. Yeah, we bought our house a long time ago. We had great credit, but that was the going rate. We thought nothing of it, and we took out the loan, and we've refinanced several times since then. So in the scheme of things, today's rates of 6% really isn't that bad. We were just spoiled by those 2, 3, 4% interest rates for such a long time. If you're renting, you probably still could maybe buy a house and have a monthly mortgage payment lower than what the rent is because rental costs are going up. And when you're renting, you're just giving the landlord money for him to pay his mortgage. So when you're negotiating, Ellen, buyers are like, wow, if I just had $10,000 more because I really, really want this house. What would that, in an average interest rate of maybe 6%, cost them per month in a payment if they would finance an extra $10,000?
That's a great question, Sherri. And I think what we're seeing right now and what a lot of buyers are seeing right now is that there's multiple offers on every property that's for sale, and most buyers are going to need to put in an offer that is over asking price. So With that being said, if you find a house that you like and it's listed at $180,000 and you feel, to be the best highest offer, you need to offer $20,000 above asking price, which is $200,000. For each additional $10,000 finance, it might only be, even with current interest rates on a 30-year fixed mortgage, about $50 or $60 extra a month. So it really still is affordable. And with all those other options, as far as, maybe doing an adjustable rate or paying points or doing a mortgage insurance buyout with less than 20% down, it can make the home even more affordable and make up the difference in that $50 or $60 a month per $10,000 in a monthly payment.
So what we've learned today is that there are options. You don't have to do a fixed rate mortgage. There's the ARM. We can have a seller maybe help give some money to buy down points. So what would be the next step if a buyer has questions to see if they're pre-approved, at what amount, how could you help them?
So generally what I like to do is talk with the client and get as much information as possible to make sure I'm finding the best loan options for them. So, in addition to getting a full application, we want to see what their credit score is, how much money they have to work with as far as the down payment goes, what debts they have on a monthly basis. So things that are fixed monthly, so car payments, credit cards, student loans, things like that. Do they have a house to sell? Do they have a current mortgage where they might want to try and qualify based on both mortgage payments, where they don't want to sell their house first, they want to qualify with their current mortgage payment and then a new mortgage as well. So there's a lot of things that go into a pre-qualification. So credit score, debt to income ratio, are they a first-time home buyer? What areas are they looking to buy in? Because that helps us narrow it down to what loan programs or what options are available for them. And sometimes some buyers, there's multiple loan options that are available to them based on the area or the county that they're looking to purchase in. And sometimes, if they have two mortgages, they might only qualify for one. So we need to look into other options as far as, do they need to sell their house first? As far as the pre-qualification goes, or the pre-approval goes, once a pre-approval is issued, it's generally good for about 4 months, or as long as nothing changes in the borrower's financial situation. So if you are a borrower and you do get pre-approved, you want to keep things the same when you're looking for a house. You don't want to go buy a new car with a very expensive, monthly car payment. You don't want to switch jobs or change jobs or quit your job in the middle of looking for a house, because that can change your pre-qualifications. You definitely don't want to start a business and quit your regular full-time W-2 job when you're in the middle of purchasing a house, because generally most self-employed borrowers, we need a 2-year work history of filing tax returns in order to see what income that business is making on paper and what they're reporting to the IRS. So there's many different loan options, pre-qualifications. You generally want to check back with your lender. If you got pre-approved and interest rates were 4% and a month later they're 5%, that could change the qualification, or we might need to relook at some numbers and make sure that still is the best option for you.
In partnering with Ellen Puchalsky from Northpointe Bank, with Explore My Town and keeping everything local, we hope that you gained some information with our interview with her today.
If you have any additional questions, you can reach me at 717-275-6270, or the link to apply online is in the comments below.